We've been seeing more pharmacists coming our way. Certainly not something that is new. We've seen it in the past, but more recently, pharmacists coming our way, interested in learning more about our services, with fairly expensive whole life policies that are costly on a month-to-month, year-to-year basis, while also trying to achieve other financial goals. And we had a recent prospective client that I think paints a really good picture of what we want to talk about in today's show. So walk us through that one.
Yeah, and I think in an effort to kind of maybe bring to light a lot of the things that I'm seeing on, prospective clients, I think this is a good one to highlight, Tim. So,
Mhm.
um, I spoke with this pharmacist that had a whole life policy as well as a number of other policies that they purchased, about 15 years ago. And I don't know if it was something from YFP or something else, but he kind of got this feeling of like, man, I don't know if this is good for me. And I've been kind of just lost in the day to day of my life and my job
Sure.
and what's going on with his young family. So he didn't really have the time and space to kind of be like, take a breath and be like, is this good for me or not? So there, it was kind of this conversation along with others. I've talked to other prospective clients that have an advisor, and they kind of at every meeting are pushing some type of whole life policy, pushing a product, and they just feel like they have to kind of like bob and weave out of it because they either don't know or they just feel like it's not a good situation. So I think it's a good time to kind of chat about this. So to go back to the first case, this individual, 15 years with these policies, he estimated he was paying about $12 to $15,000 per year in premium. Now, this wasn't just a whole life policy; it was a number of
Mhm.
different policies. Um, and the question I asked him was like, okay, well, that's a long time to be kind of amassing, a cash value. So, just to remind the audience, whole life is typically a combination of um, life insurance and an investment product, right? So
Mhm.
you have this dual kind of component to the policies. So with a whole life policy, you amass cash value over time, which sounds nice, right? A lot of people are like, "Oh, I pay for a term insurance, which is just straight up vanilla life insurance. So there's no cash value if you were to die during the time the policy's in force, whether it's in a 10-year term, a 20-year term, a 30-year term, or somewhere in between, then you would get the death benefit. But
Mhm.
you can't take loans. There's no cash value, things like that. So it's just straight up life insurance. So the question was, okay, like what have we amassed over those 15 years? And the answer that he gave me was, it was under $70,000. Right. So I'm like, man, if I'm putting in, and again, he wasn't putting in 12 to 15,000, but I'm assuming
Right.
he's putting in $8,000 to $10,000 for his policy over 15 years. Like, we should have a lot more cash value there. So I think the way that I try to approach this is with a bit of like empathy and understanding. No one wants to feel like they've made a mistake, right?
Mhm.
It's not a good feeling, especially when you feel like this policy was presented to help your family, to help your ability to build wealth, to protect yourself.
Yeah.
It could be by a trusted advisor or even a friend or a family member, right? That's
Yeah.
kind of, it gets sticky. So I really want to reinforce that they weren't wrong to purchase the policy. It's just that the tool that they were sold was mismatched with the intention that they were trying to, I think, have for their family. And a lot of smart people are sold these policies, and
Mhm.
because they sound attractive, I think they're made to sound attractive for the protection and the savings and the tax freeness that isn't necessarily so. So I think that's important. But I think to kind of go back is to kind of clarify what's the true purpose of life insurance. In
Mhm.
my estimation, Tim, the true purpose of life insurance is to insure one's life. It's really not to have an investment component. So a lot of us in the fee only world, the fee only community will often say buy term, which is the pure life insurance, invest the difference. So whatever you would have spent on that whole life policy, don't spend that money, buy term. And if you invest the difference of what you would pay versus the premiums, and I'll talk about the cost breakdown here in a second, you'll be far better off to buy term and invest the difference. So the purpose of a life insurance is to cover your life. It's not necessarily to be, an investment vehicle. And I think the big reason it comes down to the cost and returns. So I would say with whole life, a lot higher costs, a lot lower returns. For a term policy, a lot lower costs and really no returns. But if you follow the adage of invest the difference, that's where you get better
Mhm.
returns in my estimation.
So Tim, let me give a for instance
Yeah.
for those that some of the terminology might be a little bit new. When you talk about term life insurance, obviously lower cost product as you outlined. Policy is good for the term. If someone were to unexpectedly pass away during the term, let's say it's a 20, 25, or 30-year term, they essentially get that death benefit paid out. We can talk a little bit further about some of the tax treatment of those benefits
Yep.
based on the
Yep.
policy. If they don't pass away during that time period, during the term, right, which would be the goal, that's a good thing. That's the end of it, right? Premiums are gone, nothing to come back. The second group you're talking about here, under what we're talking about with whole life insurance, where we have a combination of an insurance product and an investment product, of which there may be
Yep.
a cash value that's accruing over time. And so you mentioned with term, cheaper premiums invest the difference. So for instance, let's just use some round numbers. If someone were to say buy $1 million 20-year term policy for $50, right? We'll talk about how costs of policies can be very different based on age, health history, term, et cetera. Versus they had a whole life policy for $500. The argument with the term invest the difference would be, hey, if we pay that $50 a month or whatever is the cost for a policy, instead of the $500 a month, we can invest the difference in various accounts, many of which we've talked about on the podcast, depending on one's investment strategy. Could be a IRA, could be a 401k, could be a brokerage account, et cetera. But we're trying to separate out the insurance from the investment component, correct?
Yeah. Yeah. And the example, exactly right. So the example that I give is like if you buy a 1 million term life policy at, we'll say age 35 and say that's a 20-year term, you're probably going to pay $600, just using round numbers. If you're, good health, all that kind of $600 a year. So fairly inexpensive. If you were to buy a 1 million term policy, that, again, same type of death benefit, you could be paying upwards of like 10 grand a year, right? So you have
Whole life, you mean? $1 million
whole,
whole life?
whole life,
Yeah.
correct. So
Mhm.
1 million whole life, 10 grand a year, 1 million, 20-year term, it's like $600 a year, right? So a lot of people look at I'm paying this for 20 years per month, per year, whatever it is, and I don't die, so I don't get anything. But I'm like, it served its purpose, right? And that's a good thing. Now, if you do pass
Mhm.
away, you'll get that $1 million. With the whole life policy, you're paying that money in, but those premium dollars are much, much higher, and they're going to a lot of different places, right? So they're going to actually the cost of insurance, but they're going to commissions and things like that. And both policies have commissions. But I would say on a whole is that for the same amount of life insurance, it just takes that much more dollars for a whole life
Mhm.
policy. And the cash value grows very slowly, often bond-like returns, which if you heard us talk about like our investment philosophy over the years, if you're in your 20s, 30s, 40s, maybe even 50s, like we don't really want bond-like returns. We want equity-like returns. So if we're bond-like returns or might be 2, 3, 4%, equity-like returns might be 6, 7, 8%, right? So that's the big rub is like if this particular client has less than $70,000 over 15 years, if we would have invested the difference in what he would have paid versus, what he paid into the whole life policy, he'd probably have, I think when I ran the numbers, it's like $250,000, right? So you're
Mhm.
talking about less than 70, I think it was like 68,000 versus $250,000. And that's the big difference here. So I think like there's I think the way that these policies are sold, they're often with the clauses that look very promising, that often never come true, in terms of like the projections. One of the things that you often hear with these policies, like it's guaranteed, right?
Mhm.
But I would say yes, it's guaranteed, but at a very low rate of return. A high yield savings account interest rate is guaranteed too, right?
Mhm.
So to me, inflation erodes those guarantees over time. You sometimes people are like, man, I've had this policy for like 15 years and it's almost like that sunk cost mentality, what I feel is like the decision today should really be based on what's best forward looking use of your money, right?
Hmm.
And there are things that we can look at and assess to make sure, like, is this in your best interest to keep this policy or not? And I would say often, and then to me, I would still want to do the analysis. Oftentimes it doesn't make sense to keep the policies. And I
Hmm.
think the probably the big thing that we hear with these types of policies as a ways to keep them is it builds tax-free cash value.
Right.
And that can be true, but there's also a lot other ways to do that, whether it's a Roth, a 401k, an HSA, that we've not yet exhausted, right?
Hmm.
So to me, it's really important to kind of understand that. And if we look at how a dollar of premium for whole life goes through, like it gets split between things like covering the death benefit risk, commissions, expenses, and also the cash value bucket. So whatever is left over goes to cash value, which often is not a whole lot. The guaranteed minimum rate is guaranteed. That the dividends that they always talk about are not. So the growth inside the policy is tax deferred, meaning you don't pay annual taxes on it, but the tax-free claim can get very murky, Tim, because it's not automatically tax-free. It's only tax-free if you withdraw up to your basis, which is kind of the same for a Roth. Like if you've already been taxed on those
Right.
dollars, you don't get charged, you don't pay tax on it.
Hmm.
Loans, like to access cash in your policy, you typically will take a loan. And rather than a withdrawal, and loans are not taxable as long as the policy stays in force, but you're still paying interest. Part of that goes to the insurance company to basically get to your own money,
Your own
right?
money.
So
Yeah.
like
Hmm.
to me, and you have to be cognizant of, like, if the policy lapses, like you surrender it, like the IRS treats any loans as taxable income to the extent of the gains that you have. So
Hmm.
to me, like, and some of these policies can be very, like, we're talking, 10 grand, 8 grand a year, whatever it is. It's not chump change. So there is a high likelihood that they lapse anyway. And then there's, obviously issues with, taxes on. So I do think that the tax-free cash value um, is a bit misleading because there's so
Hmm.
many strings attached to that in terms of what you have to do. And again, I think there's other, more traditional investments that have a better, much more liquidity, better access to the cash if you need it, that type of thing. So, and then I think the last thing that I would say, Tim, and then I'll shut up and let you react because I've been talking a while, is the commissions, right?
Hmm.
So a lot of what I often hear on Refrain, I'll ask the question of a prospective client of, like, if you had to make a checklist of the things that you wanted in your financial plan or in your team, for you to say, these are my people, I feel comfortable, like, what's on that checklist? What needs to be checked off? And one of the number one answers that I get, Tim, is I don't want to feel like I'm being sold a product, right? I don't want to, and I think that aligns nicely with YFP because you pay for the advice, not the product, right? And
Hmm.
sometimes when you have that overlap of the sale of a product with advice, there's a conflict of interest. So the question that you are always asking yourself as a client of, a fee based, not fee only, but fee based where you can earn commissions is my advisor acting in my best interest? Are they on the same side of the table as me, or is it kind of, are we in opposition here?
Hmm.
So, and I think this is where the big sticking point with whole life. So if you go back to that example, if you buy a 1 million 20-year term, and you're paying $600 ish a year in premiums, the commission for that policy could be anywhere from 30 to 80% of the first year's premium, depending on the carrier. So that advisor might make 200 to 500 bucks. And then there's renewal
One
commission
time.
one time. Now there
Upfront.
is a
You're talking about
trail
upfront. Yeah.
there is a
Hmm.
trail where, every year or so they might make 1 to 3% of premium. That's $6 to $18 per year, right? So that's what those type of policies yield in terms of commissions for the advisor. Now that doesn't necessarily put food on the table for a lot of advisors. You have to do that at mass to really build. Obviously a lot of insurance people will sell multiple different lines of insurance. So
Yeah.
term life is not necessarily something that you can build a career on. Whole life, however, is, and I think there are businesses and companies that, make this their business to, to sell. So whole life premiums for a $1 million death benefit often run, we'll say 10 to 15 grand a year. And it could be more dependent on design, riders, all that stuff. So first year commissions are typically 50 to 110% of the first year premium. So that advisor who might pocket $200 to $500 on a term policy might pocket 8 to 12 grand on a whole life policy. And then they have trails as well. The renewal commissions can be 2 to 5% on ongoing premiums. So that's why for a lot of these policies that have been enforced for 2, 3, 4 years, so much of the cost is front loaded that it takes you a long time to kind of dig out of
Yes.
that and actually start to build cash value. So that's one of the things when we get the in-force policy illustration, we say, okay, does it make sense to, walk away from this policy, replace it with term, keep it or not? So, and again, and the reminder of this is like those two examples, of advisor, if you look at it from the advisor's perspective, making 8 to 12 grand versus $200 to $500, that client still has $1 million of life insurance coverage, right? That's what we're trying to do. Like we're trying to provide the advice that gives the client what they need,
Mhm.
right? And what we feel at YFP, as does much of the fee only community, is that you buy the term and then you invest the difference, because
Mhm.
investing the difference will put you way ahead of, earning 2, 3, 4% over, a number of years. I'd rather have the money be put in the bank, quite frankly, than to pay it in a whole life policy. So I think ultimately this creates a huge conflict of interest, right? The advisor can make 20x more selling whole life versus term. And I think they do a really good job of dressing it up with like tax-free savings, kind of a retirement plan, an addendum to your retirement plan, which, ultimately I don't think does justice or serves the client well at all.
Tim, great overview, and I think even the way you broke down the how the commissions operate, right, in both policies. Because I think sometimes we talk about commission so much on the whole life side, we forget that term life, just like any other insurance product, auto insurance, homeowners insurance, right? That's the way these policies work and are sold. And so obviously we want to try to minimize the impact of those commissions, keep the integrity of the policy. But I thought you described well that, hey, even even a term policy, yeah, there are commissions involved, but look at the dollar difference and just think about this from a sales perspective of somebody who's trying to build a business, right? I'd have to do the math, but how many term policies would you have to sell, to do one of those whole life, right? So you can start to see as you painted the picture of why these policies may be pushed in the way that they are. And I think you effectively made the points in terms of costs, how we could use the dollars elsewhere. We're talking about opportunity costs there, obviously the conflicts of interest in the relationship. And I want to dig on that a little bit more in a moment. But one thing you got me thinking about is a piece I don't know if we talk enough about when it comes to these policies, right? So there's the mathematical component of, hey, if I could spend $50 a month versus $1,000 a month, we could run the analysis. What could I do by investing the difference? Where do we get at the end of the rainbow, right? And I do think that's a very compelling argument. But there's also a really important behavioral piece, emotional piece, if you will, of just less is more and keeping something
Yeah,
simple,
simple.
right?
Yeah.
I think sometimes we lose focus on, like, when we talk about what are our goals, right? And we sit down and our planning team works on the insurance or the protection part of the plan, and then we talk about the investing and the retirement planning side of the plan, right? Two different topics. Of course, there's some crossover there, but we have to very clearly articulate what are we trying to accomplish. What's the goal? And then what are we going to do? What is the plan going to be to support those? And I think when we start to blend those things, like in a whole life insurance policy, not only is it not mathematically compelling, but it also potentially starts to lose the focus of what's the goal of the policies and what are we also trying to achieve over here on the savings and investing side. So I don't know if you can quantify that by any means, but I do think it's something that when those things start to bleed, we just lose and we see this in other parts of the financial plan as well. We might just lose some of the focus that can come from the simpler approach,
Yeah.
right?
I often say, even with our investment philosophy, it's kind of a KISS, keep it simple, stupid. I think investing should be about as boring as paying down debt. And I think it's true with insurance, right? Like there's nobody that's coming and showing you glossaries of, whole life and guarantee minimum rate and high water mark and some of these things that just get really convoluted when you add different riders. But all that costs a lot of money, right? So I want my insurance to insurance. I want my investments to investment, meaning like that's their lane,
Mm.
that's their purpose. And I think sometimes when you blend these products for different purposes, it just gets really convoluted and you're like, what am I actually buying? And that's the same thing with like annuities. We've talked for about annuities in the past, and like these annuities can get really complicated, have multiple riders. And I think like the best types of annuities are really simple. It's something like a
Mhm.
SPIA, single premium income. I give you some money and then you pay you give me a paycheck for the rest of my life. That's it. That's all it is.
Yeah.
Maybe there's a 2% rider or a cost of living rider, something like that. But it's not all these bells and whistles. So I think and again, like that's some of the conversations I'll be like, I'll ask some questions about the policy and they're like, you know what? I really have no idea like what this is. And it kind of comes back like I have a cousin that, used to be an advisor and that's told me this policy. Now they're out of the industry and I still have it. I'm still paying on it. And I'm like, should I be doing this? I'm starting to hear rumblings that maybe it's not the best thing for me. And I think even, I think there's if you're paying $1,000 a month or more in premium, I think that's a pretty good, motivator to potentially assess this to see if there's a better way to
Mhm.
do it. But there's also that like, hey, there could be familiar family connections, there could be
Yeah,
friend
totally.
connections, things like that kind of make this a little bit harder. But I just think of this, like when I think about the financial plan, Tim, and I think it aligns itself a lot with like simplicity. I think of like the financial plan as a rocket ship. And I think that things like a whole life policy is this drag on a
Right.
rocket ship that's just not allowing you to reach the stratosphere,
Yeah.
i.e. become that 7-figure pharmacist, that multimillionaire. I think it's just, those are the things that drag performance, and maybe from a
Mhm.
mental perspective where you're like, man, I just don't know. And the hard part about this too is like, you might question it. And I think the industry that sells you the policy is just really good at saying, no,
They
this is
they got
actually
they got the
good.
objections. Yeah.
They figured it out, right? So then you almost feel like you're being gaslit. You're like, all right, well,
Yeah.
maybe I'm not crazy. Maybe this is good for me. So, you know, we talk about conflict of interest, like, and again, fee only, we make up, I don't know, 10%, 15% of the advisors out there. So the overwhelming majority of advisors have whole life as at their disposal to sell, right? Not everyone does, even though they have the ability to. But in the fee only community, I think by and large, most people would say buy term, invest the difference. But I think that, you know, the marketplace, I think, is built as such to say, hey, these are good policies. And I think the thing that bothers me too is like, I remember many years ago, a pharmacist got sold a policy by her dad's friend, and she was paying something like $1,500 a month in premium.
Ooh.
She was a 27-year-old pharmacist. Like, she didn't even have really like a need for life insurance. So it's kind of that like, you know, a hammer sees a nail, right? So an advisor like might not know anything about this person. They see they have a pulse, like I can sell them a policy. But like if you actually talk to your clients, like maybe they don't need life insurance at all, right? So like to me, it's even taking a step back and looking at, okay, what are we trying to accomplish? Does this product fit at all? And to go back to the fee only where I was going to tie it in, we don't have a dog in the race. So if the client was like, came to me and like, hey, I don't know if I need this policy, like assess it, like it could be that we keep the policy. So like there's not a conflict of interest. Now, where I would say that there is a conflict of interest, to be completely transparent, is like if someone's paying $10,000 a year in premiums, and then all of a sudden they're paying 1,000 because they replaced it with term. It does free up $9,000 for them to invest, which could affect our fees. So that is a thing. But ultimately, I think they're putting a lot more of their own money in their pocket, and they're not paying for the expense related to something like a whole life policy. So, um, yeah, but it can be very emotional. I've had this
Mhm.
conversation with my cousin who's in insurance, who wholeheartedly believes in it, and I'm just like, I don't see it. I just
Yeah.
don't see the value.
Yeah, and I'm glad you even brought up that example of obviously we're talking about, I think, different levels of conflict of interest, and but it's important to know that there as you've said before, there is no such thing as conflict free advice,
Right.
right? We believe, and obviously we're biased in this direction, that the fee only model, for all the reasons that you mentioned, allows for the most transparency and the cleanest. We have no dog in the race, as you said, right? And so long as we understand like the conflicts that may be present around that decision, and they're transparent and they're shared and they're considered in the decision making, that's the best that we can do. And there's an obligation, there's a fiduciary obligation to do that, and for the client to understand that as well. But I think it's so important, right? Because when somebody comes to us and we're talking about a topic like life insurance on the planning side, and our CFPs are working with them, because there's no dog in the race, we can step back and ask the question, starting with, do I need a life insurance policy? Right? Think about this as a decision tree. So what's going on in the financial plan? What are the reasons that would necessitate a life insurance policy? Yes, no. If yes, let's move on, right? And talk about the types of policy, probably, most likely term life insurance. Let's talk about the length of term, and let's start getting much more granular. What are we trying to do with this policy? What do we need this to replace in the event of someone's death, right? What are the things in terms of income replacement, paying off a mortgage, paying off other debts, right? All types of things. And for how long? And then we can obviously start shopping for the policy that aligns with all of those needs. And there's no benefit for which direction we go. Do we end up at a 20 or $1 million term? Do we end up at a 25, $2 million term, right? It doesn't matter. It's based off of the planning needs that we have for that client. So Tim, I want to get your take on this. Like, I think you, both of us would admit, never say never, right? And I think that there are potential situations where, often what I'll hear is, well, from a wealth building, ultra high net worth tax planning standpoint, there may be a place for something like a whole life insurance policy, right? And I don't think either one of you or I would say like never say never. But I think just going back to where we started this conversation, almost always when we see these policies come into place, there's a need for cash flow in other parts of the financial plan, right? I would say that is the exception by far, where that may come up. But more often than not, here's a great case. When you talked about this situation, right? Policy from 15 years ago, I think mid to late 40s, if I remember correctly, policies from 15 years ago, and significant impact on cash flow. And guess what? They, like everyone else, hey, we could use some more cash flow because cash flow drives the financial plan. Saving for retirement, catching up on retirement savings, saving for kids' college, right? All the things that we're trying to do. And so I think that's the piece we always have to come back to is what's the opportunity cost of the cash, and what else do we have going on in the plan that these dollars might be able to be used for?
Yeah, and I think again, those other alternatives like a Roth, an HSA, a 401k are just much, much better avenues that there are, provisions like loans, especially if with a 401k that you can take
Right.
out your basis in a Roth. Like, I just think that they're better avenues, right? So, I mean, the cases where a whole life policy might work is maybe if you have a business. So like Tim, if we wanted to use this in some way for succession for our business or things like that, it's not something that we've
Hmm.
really entertained. Um, I guess you could use a whole life policy for like a key employee or something like that. Or if you have like a straight up like legacy goal of like, I want to absolutely leave $100,000 to my alma mater, like maybe you do that and you assign them as a death benefit. I still think that something like a investment account would be better to do that,
Hmm.
and pass that through the estate. So, an ultra high net worth, if you're kind of beyond the estate tax, I guess there could be, reasons to do that. But for by and large, most of the people that are, in the top 5%, like pharmacists should be both in income and net worth. whole life isn't necessarily needed. If you're in the top 1% or 0.01%, there might be a little bit more of a case for it. But I'd still, even then, I would say maybe not so much. So I'm looking at some business opportunities or maybe ultra net worth
Right.
types of individuals that it might have a better place for it.
Tim, last thing I want to get your take on, it feels like these policies are especially targeted towards, let's call
Pharmacists.
them new, yeah, for pharmacists, specifically on LinkedIn, we hear a lot, by the way, but
Yeah.
um, a lot of pharmacists that are earlier in their career, right? Again, this is another example, right? It was a policy from 15 years ago. Now they're in their mid 40s. So that would have been early in their career. And this appears to be a trend. And I think if we connect the dots of some other content we've done on how the planning engagement may work and how an advisor is compensated, we can start to connect these dots for why these policies may in particular be of interest to a younger-ish practitioner. What are your thoughts there?
Yeah, and I think if you look at the pharmacist personality, and I get a lot of this from, kind of newer grads, it's like I want to establish a good foundation, and pharmacists are very much like I want to check this off and make sure that I'm good. And I think the whole life can sound really great in practice until you start looking at those premiums over a long period of time. I do sense that the student loan burden has retarded some of the progress, I think, with pharmacists purchasing these policies. They just don't have the disposable income that they might have had years ago. And I would say even years like when you came out, you still had the burden of student loans. So I think that, a lot of these firms that people know the names of will target doctors, pharmacists, dentists, because I think that they want to make sure that they're protecting themselves. They want to make sure that they're putting their best foot forward from the idea of like adulting and building out a financial plan. I just think that the intention, like the product doesn't necessarily support the intention, right?
Right.
And not everybody needs life insurance, right? Most are going to need disability insurance, so that might be the way in to say, hey, let's get this disability policy. You're now earning a six-figure income. We want to insure that. And then whole life comes shortly thereafter. Like I've had a couple people say I bought disability insurance and I've been kind of parrying back the calls for whole life because I just don't want to spend the money or I don't think I need it. And that creates a weird dynamic in the relationship with their, quote unquote advisor. So I think that the personality lends itself to, high achievers, want to make sure they're checking the blocks and doing the right things, that, they can be sold on these policies because I think they paint them as very
Mhm.
beneficial over the long term, that has tax-free and helps retirement and protect your
Good
family.
income
Yeah,
earners.
like
Yep.
those that would
Mhm.
pique my interest as well. And I think that's why, people can kind of get sucked in that vortex and,
Mhm.
realize in the back end, like, maybe not the best thing for me.
Yeah, I think you're spot on there. And on top of all that, I think about this from a business decision standpoint. You think about a younger practitioner population may not typically don't have a large asset base to be managed, right? So when they
Yeah.
think about fee generation, right? So if somebody is early 30s, late 20s, doesn't have quarter million, $500,000 of assets to be managed, something like a commission on a whole life insurance policy, maybe a foot in the door and obviously allow for that relationship early on until there's a certain amount or level of assets to be managed. So,
Yeah, and
um,
that's a great I'm glad you brought that up, Tim, because I think, like, often fee only like we can demonize, and I've lived on that side. That's where I started my career, with
yeah,
fee based, right? So I've never sold a whole life policy, but I have sold a variable annuity or two, and they're very lucrative, um, very high commissions. But I think, like, what I would say is that the for the most part, I don't think that these advisors that sell these policies are bad.
correct. Yep.
But it's the way these are the tools that they can use to help their clients and also potentially earn a living, right? And I just think that, I put help in air quotes because I just don't think that ultimately it does help. But I think a lot of those advisors really believe in the tax-free wealth and all that. Like, they believe that. And that's kind of the structure and the system that they're in. I tell the
Mhm.
story of, like, when I got into the industry, I interviewed with a bunch of like the big wirehouses, all the names that we know. And I just got this feeling of like, man, if I worked for this company, I just felt like, they would chew you up and spit you out. It was like reach out to all 100 people that you know and get them in here and sell them something. And
Get your phone out.
yeah,
Start
that
dialing.
wasn't my
Yeah.
personality.
Yeah.
But then I landed in the fee-based world, of not the fee-based, but like the kind of the broker-dealer model.
Hmm.
And we thought we were awesome because we didn't have to sell proprietary products. Like I didn't have to just sell XYZ firms mutual funds
Hmm.
or whatever. We could look at anything that's out there and find what's best for the client. So like in my brain, I'm like, man, I landed in the right spot. Like I'm not peddling products just for one firm. And then as I was in the industry for a while and I stumbled upon fee only, and it's like, oh, like you don't sell any products at all. You just give advice and you work with insurance companies that work with fee only. So like if I'm like, hey Tim, you need a 20-year, $1 million term
Hmm.
policy, I hand you off to somebody that will basically sell you that policy, but they're not trying to upsell you a whole life or do anything nefarious. They understand like this is what I've recommended. And then they're going to get paid on it. And there's no financial or any type of like kickback or anything like that. So it's really, I give the advice. I line you up with professionals that I don't necessarily have a financial agreement with, and then they basically sell you the policy. So
Hmm.
when I learned about that, I'm like, that's where I want to operate because that's how I would want to be treated. Right. And I think that's important to note that not bad people, but I just think that the structure and the place that they're in is not necessarily
Yeah.
conducive to putting the client's interests first.
Tim, great stuff. We covered a lot, starting with how these policies are structured, the typical fees, differences between them. We dabbled a little bit in who may or may not need a policy. We have some more information on this as well. Resource here I'm pulling out from the archives, Life Insurance for Pharmacists, the ultimate guide that we publish at YFP. We'll link to that in the show notes so folks can dig a little bit deeper and think about that. And of course, if you're thinking about not only your life insurance part, which is one insurance policy of several, and then insurance is one part of the overall comprehensive financial plan, certainly an important part. But if this is top of mind as well as other parts of the financial plan, we'd love to have a conversation with you where we can learn more about your situation, your goals, what's going on in your financial plan, share more about our one-on-one fee-only comprehensive financial planning services that we provide virtually, working with pharmacists nationwide. You can learn more by going to yourfinancialpharmacist.com. You'll see an option there on the website to book a free discovery call. Thanks so much for listening. Have a great rest of your week.